Sure.
Deferred sales trusts. Basically, you're deferring the sale of an asset, right, in exchange for a promissory note that you're going to receive back. And what that promissory note is it's going to pay you out like an installment. So it's going to pay you out over time, which allows you to kind of plan, right, as you have these installment sales. So let's just say you sell something for $100,000 to the trust. The trust is going to then give you a promissory note. They're going to pay you out over 5 years for that $100,000, might be $20,000 a year. So now you can kind of plan and navigate with your tax advisor on to limit your tax exposure. And even from cash flow situation, various other elements, it gives you a lot of flexibility, Rick.
Yeah. Setting up a deferred sales trust allows you to avoid paying 20% on a lot of your stuff, especially if it's properly structured. You may pay zero if you can keep your capital gains low enough. But most of the time we see this at the 15% tax bracket, which is still a great savings, right? 5% on the total sales, even if it's structured over a 5 or 10 year sell out period. Mm-hmm. It's better to pay small chunks than one big, large 20% chunk on a big sale.
Yeah, absolutely. Absolutely. But realize when you do these things, there are IRS regulations that must be adhered to. Sometimes it can be complex legal structures. So it's really important. And I know we've said it before, we're going to continue to harp on it. Sit down with your attorney, sit down with your tax advisor, map this out. If this is something that you are interested in, Rick and I can help you. We can put you in contact with attorneys that can help you. But this is just a second aspect, one of the slides we're going to talk about that a lot of the rich are doing right now to minimize their tax exposure.
Absolutely.
Okay?